Hello, my YouTube friends. I'm back after 5 years, I believe. I'm sorry I disappeared, but actually was probably never going to do this again until a good friend of mine, and this is the reason why I'm going to be making these videos, is because of her. She's inspired me to do this. Um, Wants to learn how to trade the way I trade, so I am going to teach her. So we basically will be going over my strategy. I'm going to teach a little bit about what the Forex market is, kind of give a glimpse of what I do when I trade, the charts I'm looking at, things like that. This video is going to be kind of like a talking head video about Forex, what it is, again, like I said, and I think I'm going to talk about what a candle is, just random things for about 35 minutes. And then the next videos, we're going to break down the details of the things I talked about, and then slowly move into the actual strategy itself. And I decided just to open this up to everybody, and I have nothing to hide about how I trade. I don't care if this thing blows up and a bunch of people learn and start doing it and make a bunch of money, because that's what I want people to do. But honestly, most people aren't going to understand it. It takes practice. But this friend, she's a good friend of mine. I think she is very smart, and I think she can get it. So with further ado, let's get on to the video. All right. This recording is live. I haven't done one of these in over 5 years. But it feels good to be back, and I have a lot more knowledge of video editing and more knowledge in the trading markets, and maybe I don't sound like a bumbling idiot in these videos. But I think today I'm going to actually talk about what the Forex market is, and I'm also kind of going to go over what this chart is, and I'm going to describe a few things on this chart so that you get a feel for it next time I show it to you. But we're going to keep it simple. We're going to keep it basic today. We're going to talk about the Forex market, which Forex is short for foreign exchange. I'm sure if you've ever flown to another country, if you haven't, then you don't know this, but if you have to fly to another country, or you're going to another country and they have a different currency than you, then when you get to the airport, you need to take your US dollar, if that's what you have, for example, and you need to go to this little thing and exchange that for the currency that that country is using. And that exchange is essentially the Forex market in a nutshell. That's kind of what this up here is, euro versus the dollar, the US dollar. Since the euro is in front, buying is buying the euro and selling is buying the US dollar. I know that sounds confusing, but it will get better. But when it comes to the Forex market, it is the largest traded market in the world. The stock market, pretty big. I don't know the exact numbers, but it's nothing compared to the Forex market. Anywhere from 7.5 trillion to 9.5 trillion dollars is exchanged every day. That's huge. It's like I was saying earlier, it's about taking the dollar, for example. Say we buy the dollar, which would be going down on this market. You buy the dollar, it's worth however how much money the euro is, versus the dollar. You're going to buy that dollar. Say you have the euro, the euro, and you need to buy a dollar. That euro is going to be worth, like right now, it's worth the euro USD is worth $1.06, and then there's some numbers behind there we'll talk about later. But whenever you do that, say you buy a dollar and it's worth $1, we'll keep it simple. Later down the road, say months from now, you decide to exchange that back and get your euro back. Well, it's not going to be worth the same amount of money as it was before. The price goes up and down every second, and sometimes very dramatically. But in this instance, the price is lingering around because we're in kind of a dead time of the day. But what I'm trying to get at anyway is that when you take a set amount of currency and you exchange it for a different type of currency, the value is going to change the next time you come back and change it back. So if I was to buy the euro, for example, which is up, and it drops after I buy it, then whenever you sell it to get it back, you're going to lose money. And that value, of course, to us isn't very much when we're exchanging it for, when we're traveling or whatever. It's only like a cent, a penny, a couple of pennies, maybe here and there. But when it comes to trading, when you trade the Forex market, you get leverage, and that leverage allows you to trade a smaller amount of money and win a larger amount of money. So, and what that unit is, instead of like, 1.06, for example, right here, that's, $1.06. Well, in the Forex world, we're trading where this 5 is right here. This 10685, the 5 is considered, it's called a pip in the Forex world, a pip. In stocks, it's, I think, a point, but here we call it a pip. This is the unit that we're trading when it comes to what each pip is worth, is considered into like how much risk you're putting on your trade, which we'll talk about later. But again, the Forex market, $7.5 to $9.5 trillion is traded every day, back and forth. That's businesses making purchases from other countries, or simply large banks making exchanges, trading. I mean, there's investors, hedge funds, different things like that are putting money in and out of the market, and all that happens every day, Monday through Friday. The market still moves on the weekend, but we can't trade it as a retail trader on the weekend. We can only trade it Monday through Friday, and that time frame is in GMT. So the day actually for us in the United States is in its central time is going to be 5 p.m. So, well, most of the time, except for when daylight savings times changes, but that only lasts for a few weeks or so until they have theirs and it switches back. But during that time, it starts technically on Sunday for us. So if you're in another country, it's different time, but for us, it's technically starts on Sunday. So this time now on these charts here, this is Trading View. On these charts, I have it set to where, see, like right here, you can see it says 1600, which is 4 o'clock, which that's, whatever time it is, depends, right? But for me here, it is 11:51. And these charts, I have them set to my time. So whenever I see a candle, it is for that time frame. So whenever we go into like MetaTrader 4, it'll be different. But for now, we're going to do all the learning on TradingView just because I paid a lot of money to use this. So I'm going to use it. But basically, the Forex market is the easiest and the lowest entry to get into trading. If you want to trade stocks, you can trade with a few $1,000s, but you're going to have all these rules and regulations that you have to follow, especially when it comes to day trading. Like, you can only take 3 trades a week. But if you put in, I believe it's $20,000, then you can trade whenever you want. And also in stocks, you're buying shares. Here you're buying pips. You're only trading pips at a time. So you can trade, you're going to put a value on that pip. Whenever you come in here and let's say we open up a trade. Where is that? We can do it like this. Trade. So right here you can sell or buy, or you can create a new order by clicking here. There's other ways to do it by opening these panels, but for example here, this right here is the buy, like a sell button and a buy button, and this right here is the spread. The spread is kind of like the way that's kind of like how Owanda, which is who I use, makes their money. When you open a trade, your trade is actually going to be opened at a higher number, and so you're automatically kind of losing, but that's okay, that's part of it. But whenever you are wanting to take a trade, for example here, it's based on units on here, but whenever you go onto MetaTrader 4, which is what I use, you can actually put in a dollar amount, which would be here. I can actually show you. That'd be easier. Open MetaTrader. All right. Beautiful sound. All right, so let's take any one of these, doesn't matter. I'm gonna make this large. Oh, that's not gonna work. I'm going to click this button, and here you can see that this is different. It's not by units, it's by actual dollar amounts or penny amounts, we should say. Right here it says 2 cents, or I know it's confusing, but we'll talk about it at another time. But if you 2 cents is really equates to 20 cents per pip. So right now, if I took a trade right now, it would only be worth, you know, like I said, 20 cents per pip. So in a nutshell, that can be that whenever you're making a trade, you are going to open the market, which I'm not going to do it right now, but you're going to open the market up. And if you decide you want to buy, for example, we'll go back to here. So if we wanted to buy here, every pip that the market moves in your favor, if you're buying, you're going to gain 20 cents if you're trading 20 cents. Now, a standard, that's called a micro lot. Then there's a standard lot, and whenever you're trading larger amounts of money, you're going to be trading multiple lots. But when you're first starting out, it's going to be, you know, 10 cents or 1 micro lot. And then whenever you have a larger account, you're going to trade a full lot. And whenever you do that, that's $10 per pip. So every time the market moves, this 0, this fourth number right here, moves 1 up, like this goes from 70, say this is 70 flat, and it goes up to 71, that's 1 pip. So that 1 pip, you're going to make $10. And so, of course, if you see, like if you were right here and you sold right here, and you held it down here, let's get their little measurement thing. We'll just say we sold here, and we bought back, you know, here. That's 109.7 pips difference there. And so if you're going to do, let's see, I'm tired, so let's hope this math is all good. And then you multiply that times $10, for example, you made $1,097 in that trade, minus your spread, of course. And in a nutshell, that's really what it is. You're just trading, you're just having a trade idea that the market is either going to go up or down for the day, and or for the period of time that you're trading. This is a 15-minute time frame. Let me go. Each candle here, we're going to start talking about candles. Each candle, this is a Japanese candle. These candles here, let's make it really big, represent what the price has done in a 15-minute frame. So this is a 15-minute. So every candle is worth is a 15-minute price change. As you're, of course, as the market's live, which it is right now, it's going to move up and down. And this is a really tight, like the market's barely moving. This is news release here, and it just goes up and down. This is a big move, by the way. But the way this candle is formed is, let me see if we can draw it out. We're gonna draw. Oh, never mind. That's not gonna work. I forgot I have it set up a certain way. We're just gonna describe it using a candle. So we're gonna pick this huge candle because you can't miss it. When the market first opened, so this candle, we'll go to this candle first. This full body candle means the price has moved and then filled back, or this market started here at the bottom and it went up and closed here. It went down and then it pulled back up. So it went up, back down, and then went up, and it closed here, making a filled buy candle. And then when it goes to whenever it opens the next candle for the next 15-minute time frame, it started here and then it dropped all the way down here. And then this wick, this little wick, means the price had pulled back. And then once it pulls back, that's where it closed. So the part where it goes down, and from the beginning it starts down, it becomes a full body. So it kind of shows you like a picture of what price kind of did. So the price opened here at the beginning of the 15 minutes and it just dropped down. And I was watching this would actually happen. This dropped fast. It dropped down within a couple of minutes. I think it was 5 minutes. And then it could pull back and bounce around all through here during the 15-minute time frame, but ultimately it closed here, leaving this body. So that's basically what this is. And so whenever you're trading, you use these as tools. All this stuff is just a tool for you to understand what price is doing whenever you're trading. So right now, for example, the market's not really moving very much. It's just back and forth, back and forth. So there's no major, there's nothing really happening. So this is like dead time for us. These times here now, you're not going to have these on your charts yet. This is just for me to tell me that during in this purple area is during the Asian time, when Asia first opens up, the banks, whenever it's around 8 o'clock in the morning in Asia, and the green is when it's 8 o'clock in the morning in Europe, and then the red is 8 o'clock in the morning in the US. And it's only the first few hours of the start. That's when most of the trading happens. At least whenever we go on through these lessons, you're going to understand why I have these here and why what they are. But essentially, this is just when I'm watching the market, and then this is when I'm trading the market, and this is when I'm closing the market over here. But sometimes I'll trade in this time. That just depends on what kind of trading strategy you pick up. I'm a day trader, but I usually open my trades between 2 and 4 o'clock in the morning, sometimes 1 o'clock. It just totally depends on what the market looks like and what targets. We'll get into that later. But I usually open in this time frame, and I usually close up 10:53 in the morning, right before the European session ends, and we're going to talk about that later. So I just wanted to kind of give you that idea of what that is. But there's different sessions in the market. There are as they go. Let me open this up here. Let me see if I have it, and I'll show you. I have it here. Thought I had it saved, but I'll look up, search for it right now. FOREX market open for hours. Here we go. If I have it still here. Oh, maybe that's why it's gone. So let's see if we can open one here, and I'll bring it over to this other screen. Market trading hours and holidays, mark for its market hours. Converter. Used to be a thing, FOREX hours map. Anyways, I'll probably have to show you that the time. I thought I had this saved, but it's gone. Don't know where it went. Let me see what it was called. It might be still on my phone. Uh, that's what it is. FOREX clock. Right. There it is. Perfect. This is a good here, and we're gonna move this. Okay, so this right here explains kind of how the forex market opens. The forex market is running 24 hours a day. So this is the full forex market, and as you can see here, it closes in 23 hours and 32 minutes. But it actually, for me, it closes Friday 4 p.m. Whoa, this thing's out of date. Anyways, maybe this thing is shut down, but anyways, the forex market is 24 hours 5 days a week, and there's some different markets like the New Zealand market. For here, this tells you when it's opening or closing at 4 p.m. our time, which is Central Time. 5 p.m. is the this is New Zealand market, it's the Aussie market. These don't really matter that much, but we'll talk about that another time. This is the Japanese market. That's an important time. Sometimes you can open trades in that market, or in that during the beginning of that time, but for the most part, we just use it for analysis. That's at 7 p.m. our time. And then these are the main ones. The Euro UK market, they open, of course, 1 hour different from each other. Trades can start anywhere between, or at least setups, or when the market starts moving, it's usually between 1 and 4 a.m. our time, which is Central Time. The Euro market, of course, starts at 1, and then 1 hour later, the UK market starts at 2 a.m. And then the US market starts at 7 a.m., and which is New York Standard Time. So that would be 7 a.m. our time. New York would be 8 o'clock in the morning, of course. And these markets overlap with each other. So, while this one's open, this one can still be open. Like, all these are open at the same time. They just close, maybe a few hours different. So most of the trading happens between when the Euro UK opens, and then it really ramps up during the US market, because then the Euro UK and the US market are open at the same time. So that's when the price is going to be moving the most. Why that's important is because you don't want to be trading when the market's not moving. Then, because it just doesn't, you're not going to make any money doing that. You don't know where it's going. Price is just kind of moving around everywhere. During these times is when the market's moving. So we're going to pull back here and look, like, for example, let's bring this down a little bit. Let's find, now the market's been kind of sideways during this month, but we're going to go back to here. This is a good spot here. So this is Euro US dollar. This is Asian range. As you can see, during the non-major times, which is the Euro and the US, the market doesn't really move that much. When it comes into here, if it doesn't move, it's going to happen during the US session. But most of my trades, again, are executed here. But anyways, during the European and UK session, the market starts setting up and moving. Usually at this time, or in the US session, the market's gonna to move up and then move down. Let's go back. I don't know. Well, this is probably not a good example because it's been sideways. The dollar and the euro have been kind of moving the same. So whenever that happens, they don't really move, period. So let's get dollar. Ooh, see if that looks a little bit better. Yeah, right here, already a good example. So right here, this is something I'll explain later. I already did analysis on this market, but right here, the Asian session doesn't really do much. Then the price kind of moves up and pulls back down during the pound or the UK session, and then it moves up into the dollars into the New York session, and it kind of meanders down. This is kind of more of a sideways day, but you can see the move is happening in this time frame here. Most of the moves are right here. The move went down right before the session. So usually when that happens, it's kind of still sideways again. It does it again. And then we go over here. most of the market movement is happening this time. It's just dead. It's not a good example. We'll squeeze it together. Here's like right here again, sideways, and then it starts to move down if that's the direction it wants to go. Another sideways day. Here we go up and then we come down and then kind of stall out at the end. Same sideways here, just sideways. It's been like this all month. This has been a really slow month. This is one of my trades I actually took here. Whenever I entered and then when I took profit. This one was a 6.71 risk to reward ratio. So that means that I risked a certain amount of money and I won 6.71 times more than that risk. This dollar amount doesn't matter because I just type these in as I take the trade so that I can see it visually afterwards. But as you can see here, the price goes down and then moves down again, and then at the end of the day, it closed. I closed it around 11 o'clock, right before 11 o'clock. Here's another. No, that's not. Well, it moved a little bit earlier, and then it comes down and then just kind of dies off. But you notice in the Asian range time, market doesn't really go anywhere. Then it moves. Here it doesn't do anything. Here's a good example here where it moved at the beginning of the New York session. It pulls up, moves down. I'll explain why it does it later, but I just wanted to show you what it's doing. Just this, and by the way, in between these two blue lines is a full day, 24 hours. So right here is another example. It doesn't really do much, then it starts moving. Here it doesn't, it starts pulling up, then it pulls back, then it goes back up. So this is kind of a sideways day. It did end up being an up day, sideways day. You're going to notice the market goes sideways a lot. Your job as a trader is not necessarily understanding when this is going to happen. It's just getting yourself into the opportunity to catch these kind of moves, the down moves. Sometimes you're going to get in the market and it's not going to go down. That's okay. It's okay to lose trades. The key of it is when you win these trades. When these trades happen, that's when you make your money. Right here, these down moves that just stay down and becomes a new day. This one pulled back up, but it's just an example. These are the movements you want to see when you're trying to get into a trade. Who knows where your target is to take your profit, but so there's just a lot of sideways, just the way it's been. It's summertime. The price doesn't move a lot during the summer. It'll start picking up now that we're in the fourth quarter. But we're gonna go ahead and bring this back to normal. So what else do I want to talk about in this video? Basically, it's already been 26 minutes. This is the Forex market. This is what you're going to be trading. I just wanted to kind of explain it to you what it is. It's just basically how banks, large companies, now they move their money back and forth. They have to exchange it. So if Elon Musk needs to buy computer chips from Japan, for example, or China, he needs to convert that money to their currency so that they can get paid and be able to use that currency. So there's going to be a price that they're going to want that to be in. You know, for example, say that they want a certain price, like right up here. They're going to start trying to get that. They have to get that money into the market. Now, for us as a retail trader, we can usually open and close a trade instantly, and it's going to be accepted. For larger companies and banks and hedge funds that are trying to put millions and millions, like hundreds of millions of dollars into the market, they can only put so much in a time. So that's why the market starts moving down, as money's going in, and it starts moving down. Our job, as at least in my opinion, which is what makes me profitable, is you're not trying to predict when they're doing it. You're just finding that highest probability time frame to enter in the market with a bias in mind of the direction, which we'll go over later, and then writing that as they're putting the money in and as the price goes down. Once they get their money in, they want a specific price. The market's gonna come down to that price eventually, and it's gonna hit it. We're gonna go into that again later as well, but for now, that's what I wanted to talk about. Understanding what these candles are, and basically that way you can the basics of it. You're not going to learn a lot on this in these videos, except for the basic stuff that you need to know to be able to trade the strategies that I teach you. You don't need to know all this other junk. You don't need to know, for example, when they talk about psychological levels and stuff, like, you don't need to know that. All you need to know is what Forex market is, and what all the basics are. You need to know to understand when I say something is when I'm talking about in the strategy, that you know what I'm talking about. Like, this is a moving average, which we're gonna go into that whenever I set up a chart. This right here is a trend line, or I use a trend line. That's what this is, to lay down where I think a level is that the price should go to, and then that's on a higher time frame kind of thing. So if I'm going to the daily, for example, so right here you're going to see I have this labeled as a monthly and weekly draw. This is where I think the price is going to go over time. And this is where the price could go up to what we call a retrace, and then pull back down eventually, because the market doesn't just go straight down. It goes up and down, up and down. And then this is the weekly draw. And then these smaller boxes, whenever you go back in the 15-minute time frame, this is areas that I'm looking for. The price, all these areas are where price could be going. Go back to the hour. So the price could be pulling. I want to see the price pull back up into these areas. They could be going as far as here, but we don't know. We never know when the market's going to do. We just try to understand by seeing patterns where we think it's going to go, so that we can take that trade and then ride it. And I like to take it day by day. So I'm going to take a sell that day, sell, I'm just going to be selling. Even if I take a loss, it's okay. It's okay to lose, because you're going to win bigger than what you lose. But if I see this price for, like, let's go back to the 15-minute time frame. So today, if I was going to sell tonight, for example, because I'm waiting for the time to come up for Euro and UK to open. This is basically the end of this is the day. This was Friday. So this is the lowest point of Friday, and this is the highest point of Friday, which is this candle here. I would like to see, because it's such a small day, the price to come up. And this is the weekly line, I believe. Let's make sure. Let's go to the 1 day. So yeah, this is the weekly draw. It's probably not going to go up there. This was like a huge, it's probably not going to come up here. It's probably going to come up to the top of this square, which I'm going to explain to you really quick. So this square is just an area where the price needs to come up into. If it comes up into this area and the price starts to move down, because we want to sell, that's what this purple line is telling me, is the market's going down overall. It has momentum to go down, and we're underneath that line, so we want to sell. There's more to it, but that's the simplest way to explain it at this point. But we want to see the market come back, because they have to fill orders to continue down. So we want to see the market go up. We don't want to see it go down. We wanted to see pull up. It could pull up here and go down, but I won't trade that. We'll talk about that later. It could come up here, could go down. But what I want, a higher percentage chance for me in my strategy, and the strategy I'm teaching you, is that it's going to come up into these boxes or up to here, and then start to show signs of going down. If it doesn't do that, if it goes up here and it keeps going up, then we're not going to trade that this week unless we get an idea where we're going to buy. But for now, we're looking to sell, because, and I'll give you a little hint, we're going to go to the monthly time frame. We're going to blow this up. This candle, this red candle means down, white means up. Okay. The week before this previous week, it went down and closed back up, but then the next time it went down and stayed down. That's downward momentum. That's what we call a bearish momentum, so it's going down. So that means for the month, I'm looking for, because we're still in this month, to continue down, maybe pull up, but we're looking for down. This week has been down, so we're looking down. This month, we're going to go to the week, and we're going to look at the week. The week is the same. Been going down. and it closed. So this previous one went down and closed lower. So we're expecting this week, this next week went down and it closed lower. So we're expecting it to continue down. When we go to the daily, you're getting a little short little glimpse of how I now analyze the market. So now we're on the daily. So each candle's worth is 1 day's worth of trading. We went down and it closed slightly lower. It went way down, pulled back up, but still closed lower, slightly lower, because it's just at the bottom of that box. And then last week we get a pull down. It closes just above, but it's still lower. We have taken out a low here, so what I'm expecting now is once we've broke this low, which we'll turn to talk a lot more detail about that, I'm expecting to come back up and come up into this box, which is the low of this previous week. And once it goes up into this area, anytime, anywhere in this area, even up here is fine. We're going to start looking for when to sell. And that happens on the 15-minute time frame right here. Again, that's why we can see everything here. Again, so basically, we're going to be looking for it to come up. And then once it comes up into here, we're going to go back down, hopefully for the week. And we're going to go on to another target. But that's for another time. Basically, this is what I do, and this is what I'm teaching you to do. It looks very confusing, I understand that, but it will get easier because we're going to break it down. Just wanted to give you a whole, kind of like a quick, boom in your face. Here's what Forex is. This is what I do in a nutshell. So on the next video, we're going to start breaking down everything kind of individually, and then go from there. I think that's it for tonight, and we're going to go into I don't know what yet, but you'll see. All right, you have a good night, and we'll see you next time.